Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Qualcomm.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITP for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saves screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list, and comes down to about $14.93 per month when billed annually after the discount. Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions.
This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
All right, let's set the stage here. Most people, they think the company we are analyzing today is really just this invisible engine inside your smartphone.
Right, like a total legacy play.
Exactly. It has always been viewed as this mature, somewhat boring legacy tech play that basically lives and dies on how often you decide to upgrade your pocket screens.
But what if I told you the market is just completely missing their real master plan?
Wait, missing it how?
Well, we're going to look at how this perceived smartphone king is quietly attempting to hijack the whole artificial intelligence revolution in personal computing.
Oh, wow.
Yeah, and completely take over the software operating your next car. I mean, the real story just isn't about what is in your pocket anymore.
Okay, but you might be listening to this thinking, why would I buy a tech stock when, global smartphone sales are cratering and consumer spending is super tight right now?
It's a completely fair question.
Right, so if they are truly building this massive new ecosystem outside of phones, we need to understand how that actually changes the math for you over a 5-year timeline. All right, let's move into the wealth building context.
So when we talk about building wealth over a multi-year horizon, the absolute holy grail is finding a severe valuation disconnect.
Yeah, for sure.
And right now, this company is heavily discounted because the broader market stubbornly views them as just a legacy telecom hardware vendor. But their underlying pivot is intensely focused on high-margin secular growth areas.
Like the AI and automotive stuff.
Exactly, specifically AI-driven computer chips and automotive technology.
I do want to push back on the term valuation disconnect for a second, though. The market usually prices things the way it does for a reason,
Right.
So why are we so confident the market has this one wrong? Is it just the new product lines, or is it like something deeper about the technology itself?
It is fundamentally about the underlying architecture they use. I mean, we really need to talk about ARM-based architecture.
Okay, break that down for us.
For decades, traditional computer processors, the ones built by legacy players, used what is called x86 architecture.
Right, power-hungry one.
Exactly. Those chips basically brute force their way through complex calculations. That requires a massive amount of power and generates so much heat.
Right.
But ARM architecture is fundamentally different. It processes instructions in a much simpler, highly streamlined way.
Yeah.
Mechanically, this means your laptop battery could suddenly last for days instead of hours.
Even with heavy AI loads, right.
Yeah, even while running incredibly heavy AI software locally on the machine.
So the broader market is clearly waking up to how valuable that power efficiency is. I mean, we are seeing peers in this specific semiconductor space trading at massive premium.
Like crazy premium.
Up to 67 times forward sales in some cases. Investors are just throwing capital at almost anything related to AI and ARM processors.
Which makes the disconnect so glaring, honestly.
Yeah.
Here's a company with some of the most established, battle-tested, proprietary ARM-based intellectual property on the entire market.
And it is largely being ignored by the momentum crowd. The market is paying a premium for the idea of ARM while totally ignoring the company actually mass-producing it.
Right, but building wealth here requires a very specific kind of temperament. This isn't some momentum trade where you are hoping for a 30% pop in 2 weeks based on a hype cycle.
No, definitely not.
The strategy here is about holding a resilient, cash-generating stock while the business model completes its transition. You have to avoid the trap of purely short-term speculative trading.
Because the legacy parts, The smartphone chips are still dictating the near-term price action.
Exactly. You are getting paid to wait, essentially, but you have to actually be willing to wait.
It really is a foundational portfolio piece for the next 2 to 5 years, not just a lottery ticket for next month.
Well, if the foundation is what matters, then we need to see how the actual numbers back up this narrative. Now let's look at the fundamentals.
The sheer scale of the operations here is staggering. We're looking at $39.9 billion in total revenue for fiscal year 2025.
That's massive.
Right. But you have to look past that top-line number and really examine the revenue mix. The real star of the show right now is the automotive segment. It just hit $800 million in quarterly revenue.
Let's unpack that, because hitting $800 million in a single quarter is a massive acceleration compared to just a few years ago.
It really is.
But management has stated a $4 billion annual run rate target. How do they actually get there? What is stopping automakers from just buying cheaper generic chips?
It really comes down to their Snapdragon digital chassis. This isn't just a basic radio dial or like a chip for your GPS screen. It is a comprehensive, cloud-connected hardware and software ecosystem.
Ah, so it's deeply integrated.
Very. It handles telematics, advanced driver assistance systems, and constant connectivity. Mechanically, once an automaker integrates that specific chassis into their vehicle lineup, Qualcomm software becomes deeply braided into the car's braking, steering, and over-the-air update capabilities.
So ripping it out means redesigning the entire vehicle's brain from scratch.
Exactly. The switching costs become astronomically high.
That sounds phenomenal on the automotive side, but we have to audit the reality of the present moment. The core segment, the CDMA Technologies division, is what actually pays the bills right now.
Sure.
For context, CDMA is the foundational communication technology that allows multiple cellular signals to share the same frequency, which is the backbone of mobile networking. And that handset division is battling severe cyclical softness.
Yeah, handset sales are definitely sluggish.
Right. People are holding on to their smartphones longer because a new phone costs over $1,000, and the incremental upgrades just aren't compelling anymore. Inflation has eaten into consumer discretionary spending.
Which directly applies heavy margin pressure to the core business. Yeah.
Exactly. You can't just ignore the anchor while admiring the sales.
I completely understand the concern about the anchor, but their financial health is robust enough to carry them through this cyclical trough without breaking a sweat.
Let's look at the balance sheet to verify that. They have $12.3 billion in cash and cash equivalents, stacked against a debt load of roughly $14.8 billion.
Okay.
It is a manageable net leverage ratio for a company generating this much cash, but it is still leverage in a macroeconomic environment where the cost of capital actually matters.
Fair. But look at the cash those legacy divisions are still generating. They produced over $11 billion in free cash flow in fiscal 2025 alone.
Wow, $11 billion.
Yeah, and that kind of cash generation funds a best-in-class capital return program. They returned $7.5 billion directly to shareholders.
Okay, let's clarify how that actually benefits the listener holding the stock. Returning capital isn't just a nice gesture, right? It fundamentally alters the math.
Totally.
They offer a roughly 2.1% dividend yield combined with aggressive share buybacks. When a company buys back its own stock, it shrinks the total number of shares available on the open market.
Which artificially boosts the earnings per share.
Exactly, making the stock look cheaper on a valuation basis, while simultaneously funding all that heavy R&D for the new automotive and AI PC wings.
So they have the immense cash flow required to fund the new growth drivers without diluting shareholders. But, the market wants to see proof of execution.
Which means we need to know when the market will actually care. That brings us to the catalyst timeline.
If we look out over the next few months, the primary event to circle on the calendar is the Q3 fiscal 2026 earnings report, coming in late July or early August 2026.
What's the street looking for there?
They are going to be laser-focused on two specific metrics. First, the exact run rate of that automotive revenue. Analysts want to see if it is still aggressively accelerating toward that $4 billion target.
And the second metric?
Second, they will be looking for any signs of stabilization or a definitive bottoming out in the legacy handset segment.
Are there any hardware events coming up?
Yeah, beyond earnings, we should be watching for potential product unveils at a future Snapdragon Tech Summit or a dedicated automotive investor day. Hardware reveals with concrete performance metrics often act as immediate catalysts for price upgrades.
We also have to zoom out to the broader macro environment, though. Hardware-leveraged equities are highly sensitive to global liquidity and geopolitics.
Oh, absolutely.
A Federal Reserve pivot or a confirmed sequence of rate cuts would act as a massive tailwind. When interest rates drop, capital gets cheaper, and cyclical stocks that manufacture physical hardware tend to run because their clients can afford to finance larger orders.
And geopolitics play a huge role, too.
Right. Any de-escalation in U.S.-Iran hostilities would remove a very heavy psychological overhang on semiconductor supply chains. The shipping lanes, energy costs, and general stability of global trade heavily impact the margins of physical tech products.
For sure.
But looking at all of this, I have a critical question. Are these upcoming automotive design wins enough to offset a delayed smartphone replacement cycle right now, or is the market actually right to make them wait until the numbers cross over?
It is really the ultimate question for this stock.
Yeah.
Right now, the market is punishing them by making them wait. But honestly, the forward-looking investor shouldn't.
Why is that?
Think about the mechanics of an automotive design win. These are not one-off sales, They represent locked-in, recurring revenue streams stretching years into the future.
Ah, so they're highly predictable.
Exactly. By the time the auto and AI PC revenues completely eclipse the handset sluggishness on the income statement, the stock will have already re-rated. The market looks 6 to 9 months ahead.
Right. Markets are forward-looking mechanisms.
If you wait for the perfect, flawless earnings report where automotive dominates and handsets fully recover, you will have missed the entry point by 40%.
Well, if the fundamental story requires that much patience, we need to see what the actual traders are doing with the stock right now. Now let's pivot to the chart.
The recent price action has been pretty frustrating for short-term holders, but highly informative.
Yeah, I'm looking at the chart and the volume is drying up significantly. The stock is in a psychological basing phase, dealing with a corrective trend near established support levels.
Dragged down by the handset news, mostly.
That and compounded by broader macroeconomic weakness. We recently saw the S&P 500 drop roughly 0.40% on geopolitical jitters, and this stock simply moved down with the broader tide.
All right.
But with volume contracting this much, does this mean the weak hands are finally flushed out, or is the market just losing interest entirely?
It definitely means the weak hands are flushed out. All the negative headlines about weak handset demand have done the heavy lifting of shaking out the retail traders and short-term speculators who were hoping for a quick tech rally.
That creates what technical analysts call a coiled spring state.
Right. And it isn't just a buzzword.
No, it really isn't. When selling pressure is totally exhausted in volume contracts, it means there's almost no one left who wants to sell at these prices. That leaves the stock highly sensitive to the upside on any positive news because buyers have to bid the price up to find willing sellers.
And the downside is actively being walled off by structural buyers. Institutional investors who understand the mechanics of the long-term automotive bets are stepping in at these specific support levels to build massive positions.
So they're building a floor.
Exactly. Furthermore, we're likely going to see a major flow rotation very soon. You have institutional capital sitting on massive multi-bagger profits in overextended names like ARM, which is up 270% year-to-date.
Yeah, that chart went parabolic.
Eventually, portfolio managers are forced by their own risk models to take profits on those extended charts. Where does that capital go? It rotates into value-oriented, discounted entry points within the exact same sector.
And Qualcomm is the logical destination for that.
It really is.
But flow rotation only happens if the broader market actually believes the narrative. So what does market sentiment look like?
It is cautiously mixed on the surface, but if you dig into the underlying industry dynamics, there are massive hidden bullish signals.
Like what?
Look at the immediate peers. Broadcom is reporting extreme acceleration in their custom AI chips. ARM's valuation is absolutely surging. The entire sector is being validated in real time. Any successful execution by this company in the new AI PC space will inevitably trigger a violent re-rating by sell-side analysts. They simply won't be able to ignore the comparative multiples forever.
That is a big if, though. That AI PC space is getting incredibly crowded. NVIDIA has made it very clear that they want to reinvent the personal computer.
Yeah, they are definitely looming.
And that is not a competitor you take lightly. They have practically infinite capital right now and unparalleled brand momentum. Think of the PC market right now like a massive, resource-rich continent that Qualcomm just discovered and started colonizing.
I like that analogy.
NVIDIA announcing they want to enter the PC market is like a rival, heavily armed empire landing on the exact same beach. It means a brutal price war is likely coming, but it also unequivocally proves that the gold on that continent is real.
That is a great way to conceptualize it. NVIDIA entering the space actually expands the total addressable market for ARM-based personal computers.
Because it forces adaptation.
Exactly. It forces software developers to optimize their applications for ARM rather than legacy by 86 chips. It validates the exact strategy this company's been executing for years, and they are the established first mover.
Aside from the massive competitors, there are also some speculative rumors floating around that could swing sentiment overnight.
Oh, definitely.
There is ongoing speculation about possible delays in Apple's transition away from these custom cellular modems. Building a reliable 5G modem is notoriously difficult because it has to seamlessly switch between different global network frequencies without dropping the connection or draining the battery.
It's incredibly hard to engineer.
Right, so every quarter Apple's internal modem project is delayed, extends an incredibly lucrative royalty stream for Qualcomm that most financial analysts had already modeled out of existence.
Plus, there are murmurs about potential AI software acquisitions to bolster their hardware ecosystem.
A war with NVIDIA, a declining smartphone market, and reliance on Apple rumors isn't exactly a walk in the park. Now let's talk about the risks.
We definitely have to lay out the primary bear case clearly, and it always comes back to the margin woes and weak handset demand.
Right. If the global macroeconomic environment worsens, say inflation stays sticky, interest rates remain elevated, and consumers simply refuse to buy new $1,000 phones, the smartphone replacement cycle will continue to elongate.
Which hits their bottom line directly.
Exactly. If that happens, their core legacy revenue faces a genuine secular degradation, not just a temporary cyclical dip. The main engine of the company could slowly sputter out.
All right.
Furthermore, going back to the NVIDIA threat, a resource-rich competitor entering the ARM PC space could compress margins across the board. If a price war breaks out to win over laptop manufacturers, it could severely limit the market share and the profitability of this highly anticipated new division before it even gets off the ground.
The bear case is entirely logical, but I would argue that the handset risk is already entirely priced into the stock.
You think so?
I really do. The market is currently valuing them at a multiple that suggests they are a pure-play legacy handset vendor in a dying industry.
Treating the auto division as essentially worthless.
Right. Wall Street is assigning almost zero premium to the high-margin auto and Internet of Things divisions that will fundamentally alter the company's margin profile over the next 24 months. The downside risk of handset softness is already reflected in the current price.
What about the NVIDIA risk?
Well, regarding NVIDIA's entry into the PC market, we have to remember the structural moat. This company have a multi-year head start building relationships and optimizing hardware with the major PC original equipment manufacturers.
That takes years to replicate.
Exactly. They also have superior power efficiency metrics, which is the entire point of buying an ARM-based laptop in the first place. That deeply established hardware and software ecosystem acts as a very high switching cost moat against any new entrant, even one as large as NVIDIA.
We've covered the legacy anchor, the automotive rocket ship, the technical chart, and the competitive threats. So with everything on the table, what's the final verdict?
The data gives this a bullish score of 7.5 out of 10.
Okay.
The core thesis is that the company is fundamentally mispriced by a market looking backward instead of forward. It is offering asymmetric upside because it is supported by a fortress balance sheet, a very aggressive shareholder return program that literally pays you while you wait, and the explosive industry-wide validation of the underlying ARM architecture.
So the catalyst is execution.
Yes. As those massive automotive design wins convert into realized recurring revenues, the valuation disconnect will violently close.
From a wealth-building perspective, the long-term view here is that this is a multi-year hold. We are looking at a 12 to 24-month investment horizon.
You really need patience.
Right. You are holding the stock to allow the automotive revenue ramp to fully offset the cyclical handset trough and waiting for the AI PC market expansion to actually reflect in their earnings multiple. It is all about capturing the transition from the old business model to the new one.
Absolutely.
Before we wrap up, think about this. If this company actually succeeds in making ARM architecture the undisputed standard for laptops, the entire legacy by 86 empire built by incumbent chipmakers over the last 40 years could become completely obsolete.
It's wild to think about.
The real question isn't just how high this stock can go, but which tech giants they are going to dethrone to get there. If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.